Welcome to the Explainer from Talk Tickers. Today, we're tackling a real head-scratcher. Palo Alto Networks just posted a fantastic quarter, beating expectations across the board. So why on earth did the stock drop? Well, we're about to dive into their latest earnings call to unpack the massive billion-dollar bet that's got Wall Street feeling a little nervous. All right, let's get right into it, because this is the central mystery we need to solve. The company's results were strong, and they even raised their guidance for the full year. But almost immediately, the stock started to fall in after-hours trading. So what happened? What did the market see that soured the good news? Let's unpack it. So first things first, let's just look at the raw numbers that created all this confusion. Because honestly, on paper, these results looked absolutely fantastic. Okay, so their non-GAAP earnings per share, 93 cents. The consensus on Wall Street was only looking for 89 cents. So yeah, that's a solid beat right out of the gate. And it's not just on earnings. Total revenue hit a cool $2.5 billion, which also came in ahead of what Wall Street was expecting. So you've got a beat on the top line and the bottom line. So far, so good, right? But here's where it gets really impressive. When you look under the hood at their key growth engines, the numbers are just stellar. Their Next-Gen Security annual recurring revenue, that's the key subscription metric everyone watches, is shot up 29%. And their SASE platform grew by a whopping 34%. I mean, these numbers tell you the core business is absolutely humming. Okay, so the numbers are great, the growth is there, what gives? Well, to understand the market's reaction, we have to look past the numbers and listen to the story that management is telling. And trust me, it's a huge, ambitious vision all centered around building one single AI-powered security platform. The big buzzword they kept using on the call was platformization. What does that even mean? Well, basically, their pitch to customers is this. Hey, instead of buying 20 or 30 different security tools from all these different companies, just buy our one platform that does it all. And you know what? It seems to be working. They landed about 60 major new customer wins on this strategy just this past quarter. And the CEO, Nikesh Arora, he really leaned into this with a sense of urgency. He's basically saying that AI is creating all these new vulnerabilities, that the bad guys are already using AI to attack companies, and that Palo Alto's all-in-one platform is the only real way to defend against this new wave of threats. It's a pretty powerful sales pitch. And check this out. They're not just thinking about today's threats. They're looking way, way down the road, talking about things like post-quantum cryptography. That's a fancy way of saying they're getting ready for the day when super powerful quantum computers can crack today's encryption like it's a password from the 90s. They're planning for this to be a real thing by 2029. It shows you they're playing a very, very long game here. Which brings us to the big plot twist of the call. This is what really started to spook the market. We're talking about a massive billion-dollar gamble involving not one, but two gigantic acquisitions. So the market was still trying to digest the news that they're in the process of buying CyberArk for a mind-boggling $25 billion, and then bam, on the earnings call, they drop another bombshell. They're also buying a company called Chronosphere, a big name in the observability space. This is a 1-2 punch that just came out of nowhere. And the price tag for Chronosphere? $3.35 billion. Now get this. Chronosphere has about $160 million in annual recurring revenue. That means Palo Alto is paying a multiple of roughly 21 times revenue. In this kind of market, that is, well, it's an eye-watering number. It definitely got investors' attention, and maybe not in a good way. So you're probably asking, what on earth is observability, and why is it worth over $3 billion? Well, think of it like this. It's like having a super advanced diagnostic tool for all of your complex software and cloud systems. It lets you see exactly what's going on, why things are slow, and what's about to break, before it actually breaks. For AI applications that need to be online pretty much 100% of the time, this is absolutely critical. So you've got a great quarter, plus a gigantic, very expensive new acquisition. How did Wall Street put those two things together? Well, let's just say with a lot of caution. And here's the result. The stock dropped about 3.6% after the announcement. Investors looked at that huge price tag for Chronosphere, and then they looked at the company's updated guidance for the rest of the year, which was only raised a little bit, and they got nervous. They're thinking, you're spending all this money, but not raising the forecast by much? What's going on here? And you really have to zoom out to get the full picture here. Over the past year, Palo Alto's stock is only up about 3%. Meanwhile, the broader tech ETF, XLK, is up over 22%. So you can imagine investors are looking at this and feeling impatient. They're thinking, we've been waiting for this stock to take off, and instead of big returns, we're just getting more big, risky bets. And that really is the heart of the issue right here. It's like two completely different stories are being told at the same time. You've got management painting this beautiful, grand picture of the long-term AI-powered future, but the market, well, the market is stuck in the here and now, worrying about the messy, expensive, and difficult reality of trying to merge these giant companies together. Okay, so with all of that context, let's get to our take. What does this all mean for the stock going forward? You can really break it down into two camps, the bulls and the bears. The bulls believe Palo Alto is going to pull this off. They'll successfully become the one-stop shop for cybersecurity and just own a much, much bigger market. The bears, on the other hand, are looking at these massive deals and all they see is risk. The risk that they can't integrate them properly, and the risk that it's going to hurt their profitability for a long time to come. So, what should you be watching for over the next few quarters? Here's what's on our checklist. Number 1, do these huge deals actually close on time? Number 2, does that core growth in their main product stay strong? And number 3, this is the big one. We need to see proof, real proof, that these acquisitions are actually going to add to the bottom line, not just drag it down. Now, if you were looking for a way to trade this whole theme, here's an interesting idea. It's called a pairs trade. You would buy Palo Alto stock, betting that their big platform strategy works out in the long run, but at the same time, you'd sell short a basket of smaller, older security companies, the ones that only do one thing. The theory is, if Palo Alto's consolidation strategy wins, those other guys are the ones who are going to lose. So, where do we land on all this? Our final take is a market perform rating. Look, the underlying business is incredibly strong, and the vision is bold. You have to give them that. But you just can't ignore the massive execution risk that comes with trying to digest two transformative acquisitions at the same time. It's a classic case of great long-term potential balanced by some very real short-term uncertainty. And of course, we always have to say, this is not financial advice.